Inner workings of the U.S. Treasury should have absolutely no impact for most Americans, but as you're about to see, in the face of an economic slowdown and at the same time several missteps by federal agencies has put the Treasury into crisis mode. I'm going to show you what they don't want you to know and how it's going to impact every American household. Now let's head over to the Wall Street Journal, where we picked today's story up with a headline: former Fed chief and now Treasury Secretary Janet Yellen says extraordinary measures to avoid default will start in mid-January. And this is a huge problem for the U.S. economy because we're already seeing the economy slow down. We're seeing cracks form in the labor market, and the Federal Reserve is behind the curve, as they always are. And when we see the government go into such emergency protocols, well, it's going to impact the economy in a way it's going to hit every American household. And the Treasury currently expects to reach the new limit between January 14th and January 23rd, at which time it will be necessary for the Treasury to start taking extraordinary measures. I respectfully urge Congress, she said, to act and protect the full faith and credit of the United States. Now, the risk here isn't that the U.S. is going to default on its debts. That's not what's going to happen, but it is going to create uncertainty in the markets, and that's a problem right now for many Americans who are dealing with high rates of inflation. They're seeing their hours worked at their job get cut. Many are now starting to face the fact that they might lose their job, and what's happening at the Treasury is going to be broad-reaching in terms of its impact of the U.S. economy. And earlier this month, President-elect Donald Trump pressed Congress to suspend the nation's borrowing limit until January of 2027. But several dozen Republican fiscal hardliners who see the debt ceiling as a crucial bargaining chip on cutting spending sided with Democrats in rejecting the plan. Now, I'd love to know what you think about this. Should Congress suspend the debt limit, or should they keep it in place? Weigh in the comments below. I'd love to know what you think, because in the past, the extraordinary measures discussed have included redeeming some investments related to civil service retirement funds. Now, what are they referring to? Not stocks. They're referring to bonds. Now, we know a lot of civil service retirement plans hold massive amounts of U.S. treasuries, and they could be sold and converted into dollars and create what's called an IOU back to, of course, the plan. This is an issue that would cause a massive amount of treasuries to be dumped on the market in a very short time, and no longer making certain investments in that fund, meaning not buying treasuries or other funds. And once a debt ceiling increase is passed, of course, those funds would be made whole. The question is, at what point? How long will this take? And in the meantime, of course, we could see massive amounts of treasuries being dumped on the market by these funds. And what would the cause of that do? Well, it would send yields higher in the short term, and that's a dangerous place for this U.S. economy. But if you're looking for extraordinary returns while we're seeing stocks melt down, we'll take a look at Momentum Timer Pro, because while on Friday stocks melted down our recent trade, and this is our big one. I haven't seen a trade set up like this in a very long time, and this chart pattern is setting up for this trade to shoot higher by as much as I believe is 10% in the near term. So while stocks are heading down, you want to jump on this. Now, we noted to our subscribers back on December 23rd that this was a high value trade. It closed over its 10, 30, and 90-day volume profiles, as well as its 6-month, 1-year, and 2-year volume profiles, putting massive support underneath this. Buy it open, massive upside target. Now, you've got to sign up to find out what this is. We have a 30-day free trial that's going to last 4 more days, and then it's gone. But if you want to trade against the machines, that's trading momentum. We also have a report to trade against machines. We put a high value trade out the day after on December 24th. Check that one out too. Again, the 30-day free trial while it lasts. Now, you get the daily report, tradable signals, my opinions on the best trades, full back tested data, stop loss levels, tracking of trades and returns. And here's the most important part. Not only do you get a 30-day free trial, at least while supplies last, but you can trade right alongside me. And we have some big updates coming for the next year. Our subscribers have been alerted to it. They're coming soon. The development team just told me they're going to roll them out here pretty quick. So jump on that while supplies last, because the risk right now is we know the Fed wants rates to go down. And here we can see 6-month bill yields yields in red. And despite the fact that long rates have been pushed up by the market and the Fed has said that they may only cut twice next year, we see short-term rates continue their decline, putting downward pressure on, of course, the Fed funds rate. And we could see in the past that where 6-month bill yields go in red, the funds rate in blue follows. But the problem here, if the Treasury has to come out and dump a massive amount of bills on the market, what's that going to do to short-term rates? It's going to send them higher. And that's a huge problem here, because right now consumers and businesses need financial relief from higher interest rates. But it's not just that, it's the impact that rates have on inflation and the broad economy. But there's another factor here, and that is, as we look into further details, that the Treasury could sell some of its assets from its emergency stabilization fund. But here we look at the details, because when I pulled up the financial statement, if you could believe this, it actually said I did not have the ability to view it. For some reason, it's disappeared. But look at this. Under current Treasury policy, the ESF's dollar funds are invested in one-day, non-marketable. It means they're not publicly traded U.S. Treasury securities, redeemable on demand, bearing interest at market-related overnight rate of return. So what the Treasury could do, at the same time they're dumping a bunch of bills from, of course, the government funds, what they could also do is dump a bunch of dollars from the ESF onto the market. That could put downward pressure on the dollar, which is interesting here, because when we look at the federal funds rate, typically when you see the Fed cutting rates, it's very bullish for the dollar, telling us we're heading into a recession or a financial crisis. We could see that happening again right around 2019 as the Fed starts to cut. The dollar heads higher going into the pandemic. But look at what's happening now. The Fed's cutting, the dollar's going higher. And so what we could see at the same time, interest rates in the short end of the curve go up, we could see dollars flooding into the economy, putting downward pressure on that. And all it's going to do is create havoc for U.S. consumers in a way and at a time they don't want, because right now they're facing high interest rates, they're facing high inflation, and they're facing a weaker job market. And historically, the most combative debt ceiling episodes took place under a Democratic president and a Republican-controlled House. This was the case back in 2011, 13, 15, and 23, when agreements were reached within less than a week before spending resources were exhausted. And that could be a problem here, because what it means is this could drag on. Now, we don't know, under an all-Republican government, maybe this will get solved very quickly, but the risk is if it doesn't, because we already saw some Republican hardliners say no to unleashing and suspending the debt ceiling. So who knows where this could go? But what we're facing now is a potential policy mistake from the Fed. As we turn to the Cleveland Fed's hammock, she says dissent was a close call, but policy should stay restrictive. And this doesn't make any sense, because right now the Fed wants to cut rates. They want bill yields to go lower. At least that's what we hear from Fed Chair Jerome Powell. But if the government dumps a bunch of T-bills onto the market, drives short-term rates up, well, then the Fed's going to have to come up with a reason not to cut. Well, what we see from the Cleveland Fed is they don't want to at all. And I believe that monetary policy will need to remain moderately restrictive for some time. And based on my estimate that monetary policy is not far from a neutral stance, I prefer to hold policy steady until we see further evidence that inflation is resuming its path to our 2% objective. So at a time we're going to see problems at the government level that's going to create uncertainty in the markets, potentially drive short-term rates up, impact the dollar, the Fed could stand back and do absolutely nothing. So we talk about policy mistakes here at the government level across multiple agencies, and this is the outcome of what we could see. Because when we go back to those periods, we see in 2011, consumer prices went up. 2013, we see a spike there. Now, in 2015, the economy was recovering, so it made sense that consumer prices rose. But what happened after that, we see even a blip here around 2023 where consumer prices stopped their downward trend. And we need to see bill yields go down, because as interest rates on the short end of the curve fall, what it tells us is that inflation's going to come down. So what the economy really needs to see is a quick drop in bill yields, bring inflation down before a recession hits, and give the chance for U.S. consumers to come out and do what they do best, that's spend money and keep the economy rolling. But you can see the combination of mistakes. The Fed going on potential pause here in January could cause massive problems. And she said that if the Fed is too tolerant of above target inflation, It may lose credibility, but did they ever have credibility? I'd love to know what you think. Weigh in the comments below. Do you think the Fed has credibility? Simple yes or no. And